All right, everybody. Sorry about that little delay. You can hear and see me now, right? Happy Thursday, everybody. Elevator music. Yeah, John, we're trying to change that. I don't think that we can, though. Can everybody hear and see me? Hopefully. Awesome. Awesome. All right. Well, markets are on their highs of the day right now. S&P's up about 37 points. The Dow is up 350. Nasdaq's up 140 in change. And it sure looks to be on the road here to all new market highs. Alonzo, how you doing? Appreciate you being here. So tomorrow we get a big number. In fact, it is the inflation number that the Fed really watches more so than CPI, PPI. This is the big one tomorrow, and it is called PCE, Personal Consumption Expenditures Index. Okay, so all of this government data, this eco data that's out there, they have fancy names, right? CPI, GDP, not NFP for non-farm payrolls. Tomorrow, PCE, Personal Consumption Expenditure. So what is it? Right? What is it if we break it down, and why is it so important to the marketplace, especially right now when there's I guess we could call it a little bit of a battle between President Trump and Jerome Powell and interest rates. Okay, but bottom line is PCE is a measure of inflation that tracks changes in prices that you and I and every U.S. household pays for goods and services. Okay, it really is an all-encompassing snapshot, if you will, to see how consumers are spending. Okay, now what makes this different from the consumer price index, CPI, okay, which is also a big inflation indicator, but what makes this really the go-to for the Fed is that PCE adjusts for shifts in buying behavior. Okay, so depending on what may be going on in the world at the time, depending on if there's weather issues, whatever it might be, this one really hones in on that and takes that into consideration. So it's really a more dynamic and maybe a more accurate reflection of inflation trends. Okay, now there's going to be two numbers that come out: core PCE and the entire PCE. Okay, and we'll go into what the difference is there. Okay, the core PCE metric, okay, that's really the one that the Fed is looking at because it uses a benchmark for determining whether prices are rising close to their inflation target, which is 2%, which I've said for a long time that 2% now that's kind of nonsense. I don't see us getting back to 2%, and I wouldn't be surprised to see the Fed raise that benchmark to maybe 2.5%. That 2% is just an arbitrary number. So while core PCE absolutely has fallen from where we were a few years ago in that peak of 5.7%. So when you hear the numbers out there that people like to throw around, that boy, inflation was never higher at 8, 9, 10%, whatever it is, this was really the peak, 5.7% back in 2022. Okay, so as I said, you've got President Trump and his what's the right word I should use? Cabinet, I'll just say for right now, pressuring the Fed and Powell to lower rates. Will they? Will they? Well, here's some of the things that are going on right now that absolutely will impact my spending, your spending, all of our friends and families spending. Okay, what's going to happen with the Israel-Iran conflict? Is the ceasefire going to hold? Is it going to ramp up again? Are people going to think, like many people thought a week or 2 weeks ago when this started, that, oh no, this could be the beginning of World War III? We better, stock up, blah, 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 blah. Okay. Now, yesterday, Powell spoke for the second day. He spoke Tuesday and Wednesday before Congress. It's his semi-annual testimony in front of Congress. And he reiterated the same things, right? That if it weren't for the potential, the big word here, potential or possibility of the tariffs going into effect July 9th, they probably would have already lowered rates. But he and many of the other Fed heads believe that just the possibility of tariffs can significantly lead to an uptick in inflation. And if the Fed were to cut rates right now, and then we see that uptick in inflation, and they have to go ahead and raise rates in a month, 2 months, 3 months, whatever it is, that's the last thing they want to do. That is the last thing they want to do. So tomorrow is going to be really, really important, because if there is still a little bit of a decline, or if PCE comes in lower than the expectations, you better believe that the mounting pressure, both on social media, maybe face to face, the mounting pressure for the Fed and Powell to lower rates will absolutely be growing and growing and growing. Okay, so here's the kind of conundrum. Okay, this is all lagging data. This is all lagging data. So any effect that we've already had from an increase in prices and tariffs is probably not going to show up in the May numbers, which we're getting tomorrow. Okay, the expectation is that this is going to show up in the third quarter and the fourth quarter. The bulk of these price increases is going to show up later on. Okay, so 2 numbers to watch for tomorrow. 2 numbers to watch for. Core inflation, which the expectation is for 2.6%. That's year over year, not month over month. That's year over year. That's the core inflation, which excludes food and energy. Okay. So the report net is expected to show a 2.3 rise, 2.3% rise. Okay. So if we come in 2.3 and 2.6 right on the mark, right on the numbers, the market probably likes that. If we come in at 2.2 and 2.5, boy, the calls are going to come out for a July rate cut. If it comes out higher, then what we'll probably see is a little shift of the curve, which I'm going to show you here shortly, about rate cut expectations. Okay, now I will throw out there what I have in the last section here. Okay, even if we see core PCE to be at 2.6%, okay, well above the Fed's target, that would still be the second lowest reading in 4 years, since April of 2021. So this is a comparison right here, okay, between PCE and core PCE. Okay, and again, the difference is the volatility from food and energy. Okay, so the headline number, that's all inclusive. The core number is typically higher, except for right here, which was post COVID. That was when the market really took off, when inflation really soared, when all that free money that was going around, people were spending. Okay, everybody, it was like a get out of jail free card, not just with PPE and the free money out there, but also people's lifestyle habits, right? Once we all got freed up from having to stay inside or be in our basements or be 6 feet apart from one another and getting back to normal here, that's what this big spike in inflation was. Everybody understand that? Okay, great. Great. So here's what I'm talking about when it comes to the Fed and how the market is pricing in where rates may be. So this is, and we've gone through this before, this is the CME FedWatch tool, okay, which is a real live up to the second probability of where rates will be at the next meetings of the Fed. Okay, so we just had one in June. The next Fed meeting is not until the end of July. Okay, I think July 30th actually is, that's a Wednesday, that's when the announcement would be. So what we're seeing right here, and you can actually, it's July 31st. Okay, so it's July 31st. What we can see right here, right now the markets are pricing in a 73% probability of no change in interest rates. No change in interest rates. Okay, now, if we get a really light inflation number tomorrow, a really light PCE number, you may see this shifting. You may see this come down maybe to 60%. I can't imagine it really going much lower than that. And then this rising up maybe to 40%. Okay, the difference here is a 1/4 point reduction in rates. Okay, but there's no question the Fed is still going to pound the table, if you will, that the uncertainty that tariffs pose for inflation is making them hold back and be cautious. All right, everybody understand that? S&Ps are now up 40 points for the day. Okay, so let's look beyond July. July is the next meeting. Afterwards, there's no meeting in August for the Fed. The next one afterwards is third week of September. Actually, September 17th is the meeting date. So what you can see now, what the market is pricing in, it's a massive, massive shift. So going out to September, market's pricing in only a 7.5% probability of rates being where they are right now. Meaning there's basically a 92, 93% probability that we will have a rate cut. Okay, it's 68% probability that there will be a 1/4 point cut by then, bringing the target rate, Fed funds rate, down to 4 to 4.25%. But there's also this 24% probability that we could see either a 50 basis point cut in September or 2 consecutive 1/4 point cuts. So if we go back one slide here, remember about a 26-27% probability only of a July cut. So that is being factored into September here. Okay, everybody see that? All right, let's get Thor's word of the day. Although today it's not a word, it is an acronym. So if everybody can get PCE up in the chat box, and we will get you all onto today's wheel. Come on, GME. For those that are in the GME position in opt vol, I know we already took half off. I don't think we have a remainder exit yet out there, do we? Pretty sure we do not. It's probably one that we're just going to monitor. Robert, we do? Thomas, not eligible. That's all right. We should still put you on there, Thomas, just to see if your name would have come up. All right. Thank you, Gus. So we'll work on GME when we're finished here. Okay, but GME is up nicely here. Okay. So back to the CME FedWatch tool and back to rates. Okay. Why is this really, I don't want to say it's imperative, but why do we really need to follow this? And why do we really need to understand what the Fed does with rates? I mean, that's because it affects what we do on a daily basis. If rates start coming down, okay, two reasons for that. And we have to be careful what we wish for. Two reasons for that. One, it's coming down because inflation is coming down, fine. But the other is that if rates are coming down because the economy is really slowing down, which it's not yet, that's not a good thing. That's why we have to, be careful what we wish for. So what happens when rates come down? Well, what does it do? It spurs activity. It spurs economic activity. People are able to borrow at lower rates. Companies like many NASDAQ companies and many companies that are in the Russell, the smaller cap companies, they borrow a lot of money. So low interest rate environments are much better for those companies. So that's why if we do see a rate reduction, you're likely to see the Russell really start ticking up, because those are the small cap companies that would really benefit from lower rates. Does that make sense to everyone? And for sure, the housing market, Kevin. Get us out of maybe the conundrum we are all in the housing market. No question about it. Something we have to consider, though, something we have to keep in mind. And, I'm not sure the age of all of you out here, but I'm old enough to remember when a 6% or 6.5% mortgage was actually really cheap, right? Rates were 9, 10, 11, 12%. Now, certainly a far cry from the 3.5%. Maybe some of you even got a mortgage below 3% a few years ago, right? But where we are now, it's 6.5 or whatever it is. Historically, that's still pretty low. The problem is the fact that there's no inventory and the fact that people that refinanced, that got in at that 3% level, they don't want to move, right? They don't want to give up their mortgages. So those play a major factor into the housing shortage, if you will. So that's one of the reasons home prices are so expensive. So you now have the double whammy of home prices going up, rates not coming down. That prices a lot of people out of the marketplace. Does that make sense to everyone? Yeah, Connie, you can't get insurance down in Florida, right? I mean, it's impossible. Or if you do, you're paying up the you know what. Exactly. Okay, one more thing I want to point out, and we'll get Thor back up here with PCE. One more thing I want to point out is the relationship between rates and bond prices. So let me bring in this handy dandy little screen here. And this is my go-to actually, guys. If you ever want to just get a quick look at rates, commodities, indices, investing.com I think is a great website for up to the date. It's not delayed data and it's free. Okay, so if we look at the benchmarks here today, okay, we see the 10-year is down 3.4 basis points. Okay, does everybody see that? 3.4 basis points. Okay, if rates are coming down, what does that mean for the price of those bonds? Rates are coming down. What does it mean for the price of those bonds? Or in this case, the 10-year. 10-year are not bonds, they're actually notes. Anyone else? Yes, inverse relationship. It means prices are going up, and you can see that right here. This is the price of the 10-year note today, and you can see that as positive while rates are negative. So that inverse relationship. Okay, and if you've ever wondered the difference between a note, a bond, or a bill, okay, it all comes down to the length of maturity on that particular fixed income asset. Okay, so bills, if you see a bill out there, not a bill to pay, but if you see a debt that the government is issuing and it is a bill, that means the maturity date is between 0 and, like right now, 30 days and 2 years. Okay, any duration between 2 and 10 years, that is known as a note. As you can see in right here, this is the 10-year note. And then any duration longer than that, typically 20 or 30 years, okay, those are bonds. So you got bills, notes, and bonds. Okay? Does everybody understand that? Bills, notes, and bonds. All right. Last shot here at getting your entry onto the wheel, guys. PCE. Get those in here now. Excellent, Kevin. See, you learned something today. Awesome. Awesome. That's a good thing. Okay, while you guys are all getting your entries in under the gun here, anybody that is interested in learning about the futures market, we have an unbelievable program. Okay, that program run by Dan O'Brien is just killing this marketplace, just absolutely killing it. And Dan is putting on a live webinar this evening, okay, which will show everybody how to use his proprietary algo system. It's called Karnak. Okay, I just put a link up here. So if you're interested, that starts at 7 o'clock Central, 8 o'clock Eastern tonight. And I just put the link up in the chat. And that'll take you to a screen that looks like this. All right. I think we're ready here. Yes, John, that's exactly the car. If you listen in to Dan tonight, that's exactly where he got it from. Absolutely. Absolutely. That is where Karnak comes from. And we have a full wheel today. Check this out, folks. Wow, we got a full wheel. Let's see. Is Mr. Swift on here? I just want to see if he is, just to see if he would have come up again. Thomas, I'm turning my head here to try and follow the wheel. I don't see you on there, so that is a good thing. All right, everybody, let's give it a whirl here. Aladdin or Steve. Nicely done. You still in the house? I know I saw you here earlier. Steve, are you in the house? Yes, no, maybe. There he is. Yes, sir. He never strays away from here. Great. You know what to do. Shoot me an email, prosperswag@prospertrading.com. Shoot me an email with your size swag and your mailing address. There we go. And we will get that out. Again, everybody, if you are interested in futures, tonight is the night with Dan O'Brien, 7 o'clock Central. Okay, link is in the chat here, everybody. Oh, Julia, you did. How do you like it? Julia's Journey Diaries. I love that. Awesome. 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 All right, everyone. Have a great rest of the day today. Market is still, it's on its highs of the day. The S&P's up 41 points. PCE tomorrow could be a big market mover. We will see. And everybody have a great rest of the day. See you tomorrow.